Are in. That is the big headline today from top technician Mark Newton of Fundstrat. He says stocks could be setting up for a big breakout in the coming weeks. Joins us now. All right. This is a big call you're making. 4,500 is your year-end S&P target. Talk to me, and more importantly, talk to our viewers. Tell them why.
Well, markets have actually improved quite a bit in the last few months, Scott. It's just that technology's influence has really disguised this rally. And so it's almost an opposite situation of 2021 when the broader market was starting to roll over and tech was holding us up. Now we've seen sectors like industrials, discretionary, communication services, financials, energy, all those sectors have shown very good strength off the lows. And tech, slowly but surely, is now starting to join suit. So if anything, our own indices look more negative than they really should be. On an equal-weighted basis, we've already seen breakouts of the broader, equal-weighted indices. And now I think tech is also starting to join suit and break out. So the combination of a better equity market at a time when we have this sea of pessimism, last week's B of A noted that, investor sentiment, investor allocation to U.S. stocks is at the lowest level in almost 20 years. Portfolio managers have very low allocation to U.S. stocks. So sentiment is still very negative. The stock market clearly is working better than many people think. And we're in actually one of the most bullish quarters of any of the 16 that make up the presidential cycle. Of all 16 quarters, this is the number one. In pre-election years, stocks tend to do better than any other quarter. So I think we have to go with the trend here and think that things are actually starting to work and do well. Yeah.
People are negative because this is just a bear market bounce. That's what they say, right? Margins are going to get hit, earnings are going to follow, and stock prices are going to go down. People just don't want to believe that, right? I just had that conversation with Mike Wilson. That's what he suggests.
Right. Well, there's a couple of things that have changed, and one is that we've seen pretty good evidence of the U.S. dollar and also Treasury yields really rolling over sharply. And so that does provide a pretty meaningful tailwind to U.S. equities and risk assets in general. The most of the world has been rallying at a time when the U.S. has underperformed in the last 3 months. We've seen EM, Europe, China's golden dragon, they're all up 10 to 15 or more percent. Now U.S. is finally starting to show some evidence. We saw semiconductors break out yesterday. Microsoft is up 4%. That's going to help the case even more heading into tomorrow. This is certainly a pivotal time, but I would argue that tech is finally starting to kick into gear. And that should help the first quarter be a lot more positive than many people are prepared for.
And you don't think it's just a reversion to the mean, or a head fake. You actually believe in the bounce that tech has had, particularly higher beta tech?
Well, look, I think we have to be probably a little careful and buy stocks with good earnings, good fundamentals, and not look at the most speculative assets out there. But I think that in general, a lot of these tech stocks are starting to look a lot better. Plenty of things working out there, plenty of stocks hitting new highs. Technology has been under understandable pressure, but it's stabilized. Now we're seeing good movement in Amazon and Microsoft and Apple off the lows. Yes, when those stocks turn from being in downtrends to uptrends, and it'll be very clear to the whole investment public. At that time, the rally will likely already be very well underway. So I like positioning now at a time of real pessimism and when the broader market is working fine and tech is starting to kick into gear and thinking this is going to be a much better year than most people expect.
All right, we'll catch you soon. That's the last word. Mark Newton, thank you very much for coming on today. I appreciate that.